Hi, I'm JP Scott, CEO of iWealth. I've been helping people create wealth over the course of 35 years. During that time, I've reviewed thousands of financial plans designed by other financial professionals. And one thing I discovered is that millions of their dollars were being systematically transferred away because they're not getting all the facts. I don't know you, but after you watch this video, I'm guessing that you're going to see some things that hit close to home. At iWealth, we developed a wealth accumulation strategy that utilizes all the facts, not just part of the facts. This system is designed to recover millions left on the table, reduce and in some cases eliminate unnecessary taxes, and all of this can be done by taking less risk. So before I give you all the facts, let's take a look at what the problem is. The problem starts with two words: deferral and deduction. I guarantee you, your trusted advisors, CPA, attorney, financial advisor, all know the difference between a deferral and a deduction. However, at some point, the words have become interchangeable, which leads clients to underachieve. Here's an example of what we call the tax debt. This illustration shows Mr. John Smith, a 45-year-old with income of $300,000. Here is his tax return without any contribution to a retirement plan, such as a 401k or an IRA. As you can see, he has paid in $56,000 in taxes that were due that year. After receiving conventional tax advice, here is his return after making a $50,000 contribution to a qualified plan. As you can see, his gross income has been reduced to $250,000. And that will reduce his tax liability by $15,488. And he will be receiving a tax refund for that amount of money. At this point, Mr. Smith believes he has a tax savings. But the facts are, Mr. Smith has incurred a tax debt. Here's Mr. Smith's balance sheet showing assets and liabilities before his contribution. He had $111,000 in cash and a net worth of $1.2 million. Let's look at Mr. Smith's balance sheet after his $50,000 contribution, and let's see where those tax savings really are. As you can see, his total cash is now $61,000, and he has a new asset of $50,000 in his retirement account. However, where he thought he saved $15,000 in taxes, he actually incurred a tax debt. Traditional accounting standards require a contingent liability, i.e. tax debt, to be placed on the balance sheet as a liability. While Mr. Smith believes he's saving money in taxes, let's illustrate how big his tax debt is becoming. After age 66, Mr. Smith's retirement plan has grown to $2.1 million. That's great, just one problem: the tax debt. Mr. Smith can take out $156,000 per year, and he will owe a tax debt of $47,000 per year. By age 90, Mr. Smith will have repaid $1.2 million of tax debt. Wouldn't it be better to pay capital gains or just no tax at all? To increase your wealth, others are going to tell you that you need to put more money in. I'm not going to tell you that. I want to tell you that if you understand all the facts, you can create more wealth with your current budget. So click on the button now and get all the facts.